I'm Daryl Timmerman. I serve as a director on the Minnesota Pork Producers Association board, and just wanted to welcome everybody here. The increased costs of labor, goods and services, and energy are all stark example impacts inflation has had on our households and on our businesses. As we start a new year, many have questioned what else is in store for 2022 and beyond. How will land prices and interest rates be impacted? What can producers do to protect their businesses? Fortunately, today with us we have two leading voices to address some of those questions. It's my pleasure to introduce Josh Cannington, VP of Interest Rate Risk Management, and Ryan Moe, Regional Director with Stonex. Good morning, guys.
Morning. Can everybody hear me okay? So thanks for coming to the hangover slot from last night's party. So good to have everybody in the room here. We will be accepting guests as the morning wanes on. We've got 4.5 hours of numbers and legal talk for you to go ahead and make this extra exciting. And to start with that, then we always have to start with the legal disclaimer. I've also been told that if you're going to start a presentation in the ag sector, you always got to start off with something bullish. And there's definitely a bullish environment around regulation, and our attorneys remind us of that every single day. Kind of want to start a little bit about who Stonex is. Interestingly enough, the leap from going from FC Stone to INTL FC Stone to Stonex, I thought would be pretty simple, but I guess not, because a lot of people don't know who Stonex is, and I want to kind of describe who we are. We're going to talk about what we think matters to start with, and then because I'm a weak person, I don't have the ability to deliver anybody any bad news. I brought Josh with me here to deliver that part of it, and then we'll finish up with what this actually means to you guys on the farm. Then we're going to go into what it means for the future, and then clean it up with some questions and comments afterwards. So who is Stonex? And so you probably would recognize us as FC Stone from back in the day, but then you'd also recognize us as the company that you saw on the statement that you got from your futures brokerage company that you didn't realize that you could actually access to in person. Well, what we've turned into is we started as, they can trace us all the way back to the early 1900s when Saul Stone was an egg trader. And trading eggs is not much different than trading oil and energy, which then he bought a seat on the NYMEX and then started Saul Stone. Then FCC was a company that was brought forward to get the small town grain elevator in every small town in the upper Midwest to compete with ADM, Bunge, Cargill, CHS of the world. And then when we combined in 2000 to become FC Stone, that was that start. 2009, FC Stone was acquired by INTL to become the worst name in business, which is INTL FC Stone. Just another example of why mergers suck. But that is just in name only because it worked out really well for us, because what we were able to do then is we were able to start offering a different class of products that other FCMs were not able to offer. And so what we do now is that we are in the financial services industry, and our target market is the underserved middle market client. So if we're going to trade energy for somebody, we're not going to go to the airlines, because Goldman Sachs, JP Morgan, all the big dogs, they want to service that client. We're not going to service the niche little mom and pop gas station either, because that's a niche market that's better served by somebody in the physical space. There's that group there in the middle that's a very underserved middle market client that is a good margin client for us, but it's also a good value proposition for them. And so that's who we focus on, whether it's in hog production, whether it's in gold mining, whether it's in FX, whether it's in any different kind of financial service anywhere in the world. If we find a little spot that we feel that there's a class of client that's underserved, then we go and we attack it, and we either acquire a company within that space or we go and service it directly ourselves. So all of that sounds good, but what does that actually mean for what do I do? So I have essentially 3 hats that I wear. I run a grain deck, so I'm a corn and soybean guy. So to say that I'm a hog guy by nature is not true, because I grew up on just a corn and soybean farm. We got pushed out of livestock in the early 80s. I also run the office up in Minneapolis, so I spend a third of my time in the management chair. And anybody that's looking forward to that, come speak with me afterwards. I'll do everything I can to talk you out of management, because it's just flat out not fun. And then the third thing I do is business development, trying to find new places to go, new different products to offer, new things for clients to get access to. So Josh, I'll let you introduce yourself here too.
Thank you. Man, I didn't think I was going to get a word in there.
No.
My name is Josh Cannington, and I run the interest rate derivative desk at Stonex. And I am a long way from home. I was born and raised in Central Florida on the St. Johns River. Went to school in Florida, got my MBA in Florida, and then joined a bank and been trading derivatives ever since. And that's primarily what I do. I got a section here in a few slides, but I'll pass it back over to Ryan. And if you don't have a coffee, I'll bore you in a few minutes.
So I've had about 4 cups of coffee already this morning, and I do talk fast, so we'll keep up. So kind of wanted to talk about what we think matters. And if you've talked to a commodity analyst, and I don't see too many other ones in the room here, so I probably won't make too many of them cry with this. But what really matters if you're going to be a commodity analyst and giving a commodity outlook to a group of producers is that you give something that everybody likes to hear. And then what we've learned, though, is you don't have to be right. You just have to be popular. And so I want to win the popularity contest within the commodities industry right now and tell you that hogs are just going to $1 million, right? And so the best way to get invited back next year is to be bullish, because if I'm wrong, well, we made everybody feel good, so it doesn't really matter. But I wanted to approach this from the angle of we're not going to give a traditional commodity outlook here this morning, because bull markets create attention. And we are in a wildly bullish market, and so everybody has poured over the S&D charts harder than you probably ever have in your career. And so if we were to get up here and give you the different format of the same chart that you've seen time and time again, I don't think that would be the best use of the hour of your time this morning. So what we want to look at, though, for you, though, is what is actually happening with all of this macro data that's being talked about. What is all of this inflation? What does the CPI, PPI, what does all of this stuff actually mean to you? And I think that's going to be more important than me telling you that I had a customer sell hogs at a 116.50 earlier this week or last week. That's a pretty good price, so there's my outlook on hogs. Corn, we can talk about that offline as well. But moving on from the price outlook portion, of which most people want to see, I think we need to talk about what the biggest driver is going to be here for the next few years. This is a chart of corn use for ethanol in the orange, and then the blue is the soy oil use for bio and renewable diesel here, and this chart goes all the way to about 2028. So we actually, as Stonex, run one of the biggest veg oil trading books in the country. And so our guys that are involved in this renewable diesel and the biodiesel space, they've got their thumb on the pulse pretty well. And what we're looking at here is a period where we are going to have a massive demand for soybeans and vegetable oil in the United States in order to feed this renewable diesel craze. It's very real, as you're starting to see almost a couple times a week, you get a new soybean crush facility that's being presented and proposed and is going to be built in town XYZ all over the place. It's getting to be such a big deal that we may as well just announce that we're going to build one right here in this conference room. We're going to be online ASAP, and we're going to have a demand shock for your soybeans before you even know it. Well, this is true, The demand is coming. It's just not going to be here right away. This craze is very real. We see some very long tailwinds for us in the demand area for soybeans, but that's good for people in this room because there's going to be a lot of excess protein meal in the market, but it's bad for the vegetarians because their salad dressing is going to cost more. So it's kind of a win-win for most of us in this room, but it is very real. But we want to also, Josh is going to get into some extensive data on inflation, but I want to go ahead before we get really, really upset about the information that he's going to share with us. I want to share with you where I think we are as an ag industry in this rampant inflation curve that we're in. So there's no data here because this is a chart that I just made up, and I'll use a baseball reference. So where we're at here is, 9-inning game, and if you start thinking about, are we in the first inning of this inflation story? If we are, we've got a nightmare of a future in front of us. But if we're in the 9th inning of the game, well, then it's already behind us. We've adjusted. We'll still maintain profitability. But I don't think where we are as ag is the same place that the average consumer is in as far as where we're at on the curve. I feel we're about right here because if you think back as to what everybody in this room has had to go through, we've been going through labor pains for the better part of the last decade. We've seen rapid increases in price in everything that we're producing on farm. As a commodity producer, whether it's gold, oil, etc., the reality is that we feel these things like inflation and these macroeconomic shocks. They happen here first. Everybody else tries to absorb it through the supply chain, and eventually the consumer feels it. So the average consumer that's living in the suburbs, they might only be in the 3rd inning of what kind of pain this inflation story that Josh is going to tell us here. They might only be in about the 2nd, 3rd, or 4th inning. I feel we're closer to the 5th or 6th inning, and I'll get into why I believe things are going to flatten out for us here through the 7th, 8th, and then maybe a little bit of escalation into the 9th. Now, this doesn't mean that I see the Chevy Silverado pickup that used to cost $45,000 now costs $65,000. I don't see that going back down to $40,000 again. But it's a little bit easier to tolerate if you think that we're here as opposed to down here. So Josh, I'll let you rip it from here.
I don't think it's all doom and gloom, but the inflation story isn't pretty. By any means. So when I'm trading rates, I care about one thing. What's the Fed going to do? And if I care about what the Fed's going to do, I care about the inputs that they're looking at. That is the labor market and inflation, because that's their dual mandate by Congress. Maximize employment, control prices. I'm kind of skipping over and glazing over the labor market part because by and large, the labor market is in an extremely well position. From a macroeconomics perspective, there's about 1.7 jobs available for every unemployed worker in the labor force. It's causing wages to go up. People are competing for a smaller pool of workers. So by and large, the Fed has kind of put the labor market to the side. This is going to let it improve naturally on its own, but they're starting to care about inflation.
But that's but that point of not enough workers for too many jobs, how many people have been living that for how many years here? Right? Again, Are we ahead of the curve?
Yep. The employment cost index is the highest since 2005. And so the labor market, they're just going to kind of let that on the back burner, improve naturally. But inflation, this is something haven't had to tackle in decades, right? PCE, the personal consumption expenditures, that's the Fed's preferred measure of inflation at 5.8%. They set a 2% target, so we're already 3x of what they're trying to accomplish here. CPI just recently went from 7% to 7.5%, and then PPI, the Producer's Price Index, is a measure of prices as they leave production, now in the double digits. So I think the inflation story is pretty comfortable. Everyone in this room is understanding that yes, it's here. The question is, how long is it going to last, right? How is that impacting rates? And then where do we go from here? So Before I get into an outlook of how I think this is going to pan out, let me touch on 2 points here. Where did inflation come from? So inflation is a well-studied economic phenomenon. Maynard Keynes is really famous about demand pull and cost push inflation being the two primary drivers of inflation. Demand pull is from the consumer, right? More demand chasing a smaller pool of products, it's going to drive prices up. It's a pretty natural an element of a growing economy, right? It's just more money in people's pockets, more people want products, it's going to drive prices up. And that's something we've experienced for a long time. And it's really what kept inflation right around 1.5% over the last 20 years. But what's really important is how much money has been dumped into the system since the pandemic. The Fed is partially responsible in fiscal policy, like stimulus checks, PPP loans. All that is the other half of the story here. And we've seen the money supply spike. Over $6 trillion added over the last 2 years, which is equivalent to what we've seen over the last decade. So you have a ton of money into the system. It drives rates down, which is good for borrowers, but it does hurt inflation. And now the second half of the story is cost push. This is something that's largely been a figment of the U.S. economy's imagination since roughly 95, which I'll show you here in a second. This is cost inputs going into products being passed on to the consumers. So you think about manufacturing. Manufacturing going overseas, products going overseas, the global supply chain growing, right? All of that's driven down the cost of products from a macroeconomic perspective. And one chart that's eye-opening is the cost of shipping since the pandemic is up sixfold. So there's congestion at the ports. Higher consumer demand isn't helping this situation out. So in a natural environment, we see demand pull, and now we have cost push. So we have kind of the perfect storm of the inflation story panning out here. And now we have CPI at 7.5%. And we have no way of knowing when this thing's going to top out. The last report, estimates were at 7.2. It hit 7.5. It drove short-term rates 20 basis points higher. It drove long-term rates higher, and more of that's largely expected. So this is what I was pointing to, cost push. This is the PCE broken down by services and then broken down even further into durable goods. Say manufacturing in the U.S. peaked in the 70s. And then right around 95, prices for durable goods actually became deflationary in the U.S. And that component of PCE kept inflation around 2%, 1.5% for a long time. Come 2020, you cut off the ports, you put people at home who only want goods instead of services, prices skyrocketed, and we have yet to see a top here. Okay, so that's kind of where it came from. Now we're in this situation. Everyone wants to look forward. So where do we go from here? How long is this going to last? So what I did was I looked at that PCE, the most recent report, and broke it down by subcategories and then sorted largest to smallest. And what you see is, the largest contributors to inflation, it comes from the energy sector, it comes from food, and it comes from anything with a semiconductor involved in its manufacturing. So right off the bat, energy, right? Oil. West Texas is approaching $100 a barrel. The fuel oil, 46.5%. You name it. Electricity is one of the top contributors. And with tensions overseas, it's largely expected to come down in the years, but who knows, how high this number gets to. Second category, semiconductors, right? You hear it all over the news. Everything from Ford shutting down F-150 production to everything else from everything that has a computer chip really is impacted, which, look around the room, it's hard to find something that doesn't have a chip in it nowadays. Used car prices, try to go find a car on a lot somewhere. It's limited supply. They know it. Prices go up, right? New vehicles, production facilities get, shut down, limited production. Those prices start going up. And what's unique about this problem is that 80% of that production of semiconductors is built in Taiwan. 80% of it worldwide is built in Taiwan, China, and South Asia. Luckily, I guess the only silver lining here is that that problem is known, right? And they just passed a bill to boost R&D, and they put $95 billion over a 6-year period into this problem. Intel just announced a production facility in Ohio. But to my point here is, we have a real problem with getting the inputs we need into products, but the solution can't be done tomorrow. This is over a multi-year solution to fix everything that's going on. And if someone thinks inflation is just going to naturally go away, or they're going to call it transitory, I think they're grossly misunderstanding where the problems came from and how long it'll take to resolve them.
But this situation with semiconductors isn't that different from what's going to be a rise in soy crush capacity. It's not all stuff that's going to happen tomorrow. I mean, this is like a 6-year program. Like, how long is it going to take for Intel to build that chip manufacturing plant in Ohio? All of these plants are going to take a while to build. It's going to take a while to ramp up. The thing about commodity producers, though, is we feel that shock early, i.e. $16 soybeans, in order to procure enough soybeans for the fact that we're going to run off of batteries and bean oil, according to the average U.S. suburbanite and average Super Bowl commercial. We're going to need to ramp up that. And how do we ramp up that? We do that with price. We do that early. And so we see things before we see things in this industry before the rest of the world starts to feel it.
Yeah. And the last point I looked at was shelter, because CPI, PCE, no matter whatever 3-letter acronym you want to look at inflation, it's not going to be perfect. And one aspect it's imperfect, it excludes home price values, but it includes rent. And rent was deflationary in 2020 because there was a moratorium on evictions. That ended. Now rents are now tracking home prices higher. So while rent was, something to ignore last year in the inflation story, it's going to be a huge driver this year because it makes up about 20% of the weighted basket that it measures. So inflation's here. It's not going to go away overnight, but it likely will dissipate on a slow scale.
But this is a pretty significant number for the pork producers in the room, because I think this has a lot to do with the wealth effect of the people that live in the suburbs. If the wealth effect of those that live in the urban areas is high, what do? They spend more. But as soon as they don't start to feel wealthy, then they spend less. They spend less, they buy less food, they buy less high-end things. This could be the bigger problem facing us as far as the inflation story is what happens if the people in the burbs that we like to complain about all of a sudden stop feeling rich. That's a big driver of the ability to pay more for food and pay more for everything else that they do. Go out to eat at fancy restaurants. So we need them to continue to feel rich, and this is a big issue right here with this rent situation.
Yep. So this is not my outlook, but a median forecast from economists surveyed by Bloomberg. And it's a pretty wide range this year. Inflation may be topping at 6%, coming down to, some people think 2%, right? This is going to magically go away. The median forecast is right around 4.8%. I'd imagine it being north of 5%, being a more realistic number. And then out in 2023, that median forecast drops to 2.4. I still think we're north of 4% in 2023. So why does this matter? It's driving the rates market. It's the only thing that people talk about, because if inflation's here, this is what happens. Inflation's high. The Fed has to raise rates to control for it. They only have so many levers to pull, right? It's QE, and it's raising rates. Raising rates is by far the most useful tool, because raising rates hurts consumer demand, naturally bring down inflation. So this is what happens in a normal rate hiking cycle. Inflation goes up, the Fed chases it down with rate hikes, and when the Fed funds becomes larger than inflation, right? Inflation gets under control. That's when they start slowing down monetary policy. We saw it in 2004, right? Inflation starts ticking up, Fed raises rates, that basis turns positive, and then they start slowing down again. In 2015, we saw the same thing. They took rates from 0% to 2.5% over a 3-year period. And that was when inflation it touched 2% a few times, but it was largely under control. And And now look at our current situation. CPI at 7.5%, PCE at almost 6%, and the Fed funds is at 0, right? We'll probably see a rate hike in the next few weeks here in March. But my point is, we'll probably meet somewhere in the middle, right? Maybe around 4%, 3.5%. But what's really interesting is, despite inflation being where it's at, despite the Fed, being well behind the curve here, the market in the forward market is only pricing in roughly 6 rate hikes this year from the Fed. It's a pretty aggressive out-of-the-gate stance for the Fed to take. In 2015, they raised rates once. They waited a year before doing it again. This time around, they have a problem at hand. The house is on fire. They need the water hose now, so they can raise rates pretty quickly. There's about a 75% chance that we'll see a 50 basis point hike here in March. So what does that mean? If there's $1 million on an operating line somewhere out there on a floating rate basis, you're going to pay roughly 15 grand more in interest this year if the Fed actually raises rates 6 times, right? But the shape of the yield curve, the shape of the forward curve, that kind of tells you a story of how the market's thinking about inflation, thinking about how the Fed's going to tackle it. And this is a really weird shape for it to be in. It almost looks like a plateau. They think the Fed's going to raise rates 6 times, and then a total of 8, and then nothing thereafter, right? It's almost a flat line. And it's almost like they're pricing in the Fed to make a mistake here, right? They're going to make a mistake. They're going to raise rates too quick. It's going to hurt the economy, and then they'll be forced to stop controlling inflation. I don't think that's going to happen. I think the gradualism approach will start seeping back into the markets when we get some more positive data from earnings and things like that, when that risk-on sentiment catches on again. I think this curve is too steep on the front end and too flat on the long end. So this is where we're at. If you have any type of long-term debt, you haven't missed the boat yet. Rates are still historically low. And if you're thinking about refinancing, sooner rather than later is probably the best approach, because rates will start to rise here. Being in an inflationary environment, it's very bad for bonds, right? You put money into you buy the bond, you put that money away, 10 years down the road, inflation will eat away at all of that purchasing power. So holding bonds in an inflationary environment is very bad, and it typically drives yields up, right? And that's what will probably happen here through 2022 and through 2023. I think we'll turn sideways maybe on the 10-year for a little bit before going higher. I think we end right around 2.5% this year before hitting 3% next year. So why does that matter? Any type of unhedged variable rate debt you have, be prepared to pay more because the Fed's going to be raising rates. If you have long-term debt, consider refinancing before these things get out of control. Because, when inflation was like this in the 70s, the 10-year was in the double digits, right? Nobody has a crystal ball of how this stuff works out. The Fed has tools to raise rates to control inflation, but it's not perfect. The Fed's not going to go and build a semiconductor plant somewhere to resolve these problems. They can only pull the interest rate lever here. And interest rates you hear it all the time, but interest rates will rise, and it's because of the inflation story that's driving it. Is that my last one?
So
Yeah.
what does all that mean for Minnesota? What does that all mean for my family farm in Iowa? I mean, it's a lot of data, it's a lot of numbers. A lot of this stuff typically doesn't matter on farm from a macroeconomic standpoint because we just want to produce. So, can you guys read this, or is the font too small? I want to start, though, by making sure that everybody in this room realizes that I honestly believe that the American farmer is the greatest farmer in the world, and it's a very, very unique sector of people when you look at everybody that we know is a farmer, but the realities of the United States are that less than 1% of the U.S. population is farmers, and we could feed the world out of this room pretty easily if we were allowed to. We're the greatest farmers in the world. We're likely the greatest farmers in history as well. But I don't see a repeat of the 80s. that was a lot of bad news. We look at the amount of money that was presented, or that was printed here in the last couple of years, and it's unlike anything we've ever seen before, but I don't think we're going to live through the 80s again. I was born in 81. I remember what it was like growing up in that era. I don't think it's going to be the same because too much was learned. We've got a lot of the folks that lived through the 80s. They're in senior level positions now on farm, in banks, in other parts of the ag sector. So I don't foresee this happening again to where lots of farms get blown up because of extremely high interest rates, because I think things are going to naturally cool off. Farmers are farming longer, so therefore that experience stays in there. People that are a little bit younger than me didn't feel what it was like in the 80s, and so therefore they maybe are going to be those people that try to go to war again. I don't see that happening because of the amount of seniority that's staying in the farm sector today, and too much was learned. The equity situation from the 80s versus today is also completely different. I want to say that like 85% of the farmland in Iowa is owned outright. Am I accurate on that number? Or it's something like that. It's 75, 80%. Dusty, is that what the banks say? So we're sitting in a spot where we're in a completely different equity situation then versus now. Also, the commodity production side, I think we've already hit a little bit on this. We've seen this. We feel it first, and we feel it harder than everybody else. And then it essentially kind of bleeds through the economy as the supply chain works itself through. We felt the pain on labor. Input price escalations are something that have been commonplace in this industry for a very long time. Expansions and contractions, those are happening. They're happening at a rapid rate, but we've felt that in the ag sector before everybody else in the suburbs ever woke up. But here's the thing about commodity production is that it can only take so much, right? So if you think about, you can't just go up, up, and away forever because we don't have an unlimited place to go ahead and lay off the inflation. So if I think about a gas station, the model on a gas station has almost forever been you try to make 14 cents a gallon as a margin on your gas. Okay, if you are selling gas for $1.50 a gallon, and you've got a 2% fee that you owe Visa, MasterCard, and American Express for credit card fees on a $1.50 gallon of gas, that's a 3-cent ding to your margin. Now we run up to $3.50 gas. That's a 7-cent ding to your margin, but you're still only making 14 cents a gallon on your gas. If you go into any level of commodity production, I can go into a grain bin for a grain elevator. I hear that grain bins now cost $4 a bushel to build. No grain trader in the world can make enough money on basis and spreads to compensate for $4 a bushel. So what's going to happen? The grain elevators are going to stop building bins. Stop building bins. Well, they're going to have to get creative on how they pile grain. Well, what happens to the bin? What happens to the bin builder that all of a sudden had a whole bunch of business, now has less business? Prices kind of naturally level out, flatten out, or go down. So these things, this is why I think we're in the 6th or 7th inning here, is because of how we've already felt. Production costs, pig space. Gavin, what were they 9 months ago versus what are they today? It's going to naturally stop the expansion, and so that because there's only so much we can take as commodity producers, whether we're hogs, whether we're grains, whether you're energy, like it all is the same for the commodity producers, and they eventually have to either have the price inflation, which eventually people stop paying that, and then that stems inflation. So seeing it go up to the moon forever, I can't say that I'm on board with that because eventually this stuff stops, and we've already started to see the stoppage of expansion already in our space. Infrastructure takes way too long to keep up. Your story about Intel building the plant. Well, there's also a problem with free government money in the space of solar, right? So I was on a call with a group out of Indiana, and there was a guy that was talking about he was going to get paid $1,000 an acre for a solar farm to be put on his farm. Everybody's all gung-ho on this. The applications for these leases have just absolutely overwhelmed the solar farm company to the point to where they've stopped taking applications because they're all full. And the reason they're all full is they can't build the solar farms because they don't have the infrastructure in place to hook the solar farm into the grid. So the stuff all takes time, and it takes time to build these things. It takes time to get those solar farms built. It takes time to get all this stuff in place, and by the time it's in place, how do we know that stuff just hasn't hit the fan and everything is turned around negatively from an economic standpoint? It takes time for this stuff to work its way through. Again, if you feel like you had been living in the future because of all the things the Fed is talking about now about there being too many jobs, not enough labor, it's because we've lived through a lot of that in ag already. And we're going to continue to live in the future because you guys are going to see it level off faster than everybody else too. I don't think we're going to overcorrect like we did in the 80s. Again, there's too much seniority, there's too much expertise, there's too many people that the equity situation is completely different. So when we hear a doom and gloom forecast out of the Fed and about all the money that was printed and all the negative impacts that are coming from it, most people in this room, their mind automatically goes back to what it was like in the 80s. And it was terrible. It was a shit show, and I don't think we're going to go back to that for a lot of the reasons. So there's good news. So what do we actually want for the farmers? As painful as this is to say, you need successful people in the suburbs. And there's a lot of people in the last 15 years that I've had my career going that are mistaking luck for talent. As they're starting to make their way up, doing whatever job they're doing and working from home and all of these other things, that's important because they go out and buy a $450,000 house. How they're making all those payments and all that stuff work, I mean, I have no idea. But the reality is we need those people to continue to feel rich, because if they feel rich, they buy what everybody in this room produces. So we need that to continue. Fuel prices in this area, I don't feel are such a terrible thing. Everybody likes to complain about it, but who's driving less? Nobody. The people, if they're driving less, it's because they're commuting less. I've got friends of mine, and my better half, she actually works in corporate America, and they're going to this 1 day a week model. I'll tell you, the working from home thing from a management perspective is a complete disaster. Everybody wants their work-life balance. These people have very fit dogs because they're on their conference calls and walking their dogs. Everybody thinks this is going to last forever, but the people in management and these companies are saying it's going to last until we have a bad quarter, and then everybody better get their ass back to work. They haven't had a bad quarter yet. So the work from home pipe dream, I think, is going to soon, maybe won't come back to 5 days a week, but all these people that moved up north the lake in Brainerd and have a job in Minneapolis, they're going to regret that at some point. The Olympics need to end. I don't have time to get into my I might, but I don't have time to get into my rant about China pollution and China shutting off manufacturing 6 or 8 months ago because they wanted to have a clean air look when they were on NBC for the Beijing Olympics. I can go into that later for anybody that cares to listen, but they're going to get back to producing. They're going to get back to manufacturing. And I think a lot of these supply chain hiccups, I think they're going to be over here because China needs to produce. I haven't actually watched the Olympics, but the air looks clean out there, and that's ultimately what they want because they need to look good. The middle class somewhere. This is something where we as an industry really need to focus on is most of the stories in this room, as far as careers, have been written because of the rising middle class in China. It's created a bull market for the products that we produce. It's extremely important. Is China capped out? I don't know. Is there a massive amount of risk by being dependent upon one customer? Ask the guy that builds a trinket that his only customer was Walmart, right? That guy ends up getting screwed in the end. So we want to have a rising middle class somewhere, whether it's India, whether it's Africa, whether it's somewhere else, I don't care, but we need to have a rising middle class somewhere on this planet so that we, as the American producer who can produce through anything, can produce something for them. We also have a marketing issue. If you Google seed corn, you'll find like ugly pictures of people's feet. Because a corn is, I guess, something that's on the bottom of your foot. That's gross. The fact that that's the case in something from Pioneer, something good about America doesn't show, about agricultural America doesn't show up, we've got a real marketing problem. People are asking me, I've got, Junior, he's 16 years old and he's heading to college pretty soon. What do you think he should do? I don't think he should get an ag business degree. I think that student needs to go to the most liberal university they can possibly find if they have intentions of coming back to the farm, so they can learn how to sell stuff to those people. Because we're going to teach them everything we know about ag the first days they come back. They're passionate about it. They're going to learn about it. We need to learn how to market to these people. And that's something that we really need to work on as an industry. We've got enough research and we've got enough analytics. We've got enough studies to tell people about food, but that's just not working. So we need to go ahead and play the game that those people are playing, which is pay for lobbyists and attorneys and marketing and ad executives so that people will start to eat the stuff that we want to produce and pay premiums for it. So this is a book that I strongly recommend everybody read. It's also on the audio book. That's what I'm taking in right now because I don't read very fast, which probably doesn't surprise anybody in this room. But it's a friend of mine, Damian Mason. He's a guy that he writes a book, and I suggest you buy one for yourself and then one for the most liberal person that you know that lives in a major metropolitan area. He does a very good job of telling the story that we have here in the upper Midwest. It also does a great job of telling why some of the things that, the dirty tricks that are being played against us, how we can go ahead and combat those. It's a phenomenal book. Damien does a great job speaking as well. And so if you guys are looking for a speaker for an industry event, Damien does a great job. And with that, we'll go ahead and field some questions. Yes.
Why do you think we will not have stagflation like we saw in the former time?
So the question is around stagflation, and why don't we think we'll see that? So Josh, go ahead.
I think that the labor market's too strong. If there's so many people employed making more money, I think growth follows.
Do you think the Fed has the management ability not to overreach on the interest thing?
I think they're going to take rates sharply higher, but I don't think it's going to have a huge dent in the growth picture that many people think. I think the economy can handle 1% rates, 2% rates. I think once you get closer to 3%, I think people start to get skittish, but I don't think we'll see stagflation that bad. I think the Fed, I think the economy can handle higher rates.
Nothing over 10.
Nothing over 10. I don't think we see double digits.
Josh, do you have any numbers around, I had heard that if rates go up a percentage point just due to the amount of government debt, mind you, this is if a government cares about debt, that a 1% rate hike equates what we spend on national defense every year.
Yeah.
How some of those metrics, what they kind of actually mean versus what the headline writers and the clickbait clowns want you to read and believe. What are some of those? What does some of that mean according to on our government debt?
Yeah, obviously they're going to pay more in interest with the rates going up. But what we saw in 2020 is that the government was pretty strategic about refinancing a lot of their long-term debt. So they already did a lot of issuance in 2020. I think higher rates, there's always going to be demand for U.S. denominated debt, the U.S. dollar. The power that the U.S. government and the U.S. economy has, there will always be buyers for that debt. Even if they have to refinance down the road, I don't think we'll get into an apocalypse situation. But I think they can stomach higher rates. If they have to refinance long-term debt in a higher rate environment, I don't think we'll be in a higher rate environment for decades per se. But I think we'll just be just fine.
So the government refinanced,
Yes.
just like I did on my house?
They issued a new tenor, a 20-year treasury in 2020, which is new to account for all of that.
So they created a mechanism for them to refinance their own creation of a problem. That's America, folks. Yeah.
China, I believe, is one of the countries that owns the most of our debt. Now, with inflation, we've had zero inflation for years, so they're not getting paid anything for their debt. Now, if our dollar is worth 10% less or 15% less, they're going backwards. I know they came in, they bought our largest hog packing plant and hogs, and they bought a second one now with hogs. How much is the U.S. government going to let them come in and buy? Mexico won't let anybody come and buy anything there.
So when I was having this conversation, so the question is around China coming in and acquiring more of U.S. ag assets. It's a fair summary. So when I had this question asked when I was talking to a group of row crop farmers, and they were up in arms because of land values going up because of people like Bill Gates, rumored to be coming into the space. And so if I'm China, what's that? They're going to buy corporations, and they're buying corporations for strategic reasons. They bought Syngenta because they raised 95 bushel corn, and they just stomped on the accelerator to be able to produce 140 bushel corn in a matter of a few years. That's why they bought Syngenta. If I am them coming in and buying assets, I don't come to the U.S., which is a premier supplier. I go and look at countries like South Africa. So if you talk to people from South Africa, they'll tell you South Africa is basically Chinese now. You look at other major bread baskets in the world that are in complete political disaster areas, Argentina. Why would you come and buy U.S. assets that are high-priced, whereas you can go in and buy places like Argentina and have a clown shoe of a government and another socialist government and be able to buy assets in a place like that for cheap and then be able to apply what you're buying in technology from around the world or stealing in technology from around the other places like the U.S. and parts of Europe and apply those practices into some place like Argentina. So I would say that they are less interested in the U.S. because we're expensive and will eventually stand for something when you can go into Argentina and just buy a couple of extremely terrible politicians. Does that help kind of walk around the question at least? Yeah.
Do you think there'll be a stock market correction? And if there is, how will it affect agriculture?
How deep of a correction do you think would be considered a correction? 10%, 20% pullback? You know what? I think all of those fears have already been priced in to an extent. You see it in the tech sector. NASDAQ's already pulled back, 10% in January. People are scared of the Fed raising rates. That's it, because when there's cheap rates, the Fed's dumping money into the economy. It's a party. You know, you buy up all the growth companies you can, and then when they start pulling that rug out, people start selling pretty quick. A full-on bear market in equities, man, you're starting to think about it. Valuations start coming into play. No I guess is my short answer, but the probability isn't zero, right? You know, it's something greater than zero, maybe less than 50%.
I would say that a stock market correction should happen, but it doesn't hurt us in Mankato until whenever that person in the suburbs, it starts to impact the value of their home, which I have a major beef with people that consider their house their biggest asset. I mean, you got to live somewhere. I mean, it's an investment, but it's not an investment. But that's another story for another day. But if a stock market correction happens, it will have cut too deep once home prices start to decline. So whether that's a 10% correction, a 25% correction, frankly, I'd like to see us toe that line and just see how far we can go before the wealth effect in the suburbs starts to be impacted. So I personally would like to see it happen, just because it's run so hard for so long that's just not natural market cycles. And the longer we run, the more painful it could be.
Help me understand, you have DDGs listed as a positive for the swine industry. I mean, we know how to feed hogs without DDGs. Obviously, it has an effect on corn price. And I would say they're probably more negative from a biosecurity standpoint and a lot of other things that come in DDGs into swine feed. So where are you coming from seeing that as a positive?
So I worked at Purina for 5 years, and what I learned at Purina is that everybody in this room has forgotten more about animal nutrition than I will ever know. So from that perspective, to me, to get into where DDGs fit into a ration is the same thing as a nutritionist giving you an economic outlook, right? So for me to comment on that question is like we got to ask the nutritionists and have a nutritionist be able to answer that in a way, and I can work with them to kind of see how this works together better. But without a nutritionist up here, I'd be doing a lot more harm than good about going into that. Protein meal excess amounts of protein meal is usually pretty good when you look at a long-term outlook for animal production. Now, I say that, though, because what we have proven as the American corn and soybean producers is that when demand shocks happen, they answer the call. And so I don't want to get too far into that because I'll be in over my head in about another 15 seconds. I am, but I'm admitting that, though, too. But I'm admitting that, though, too. But I'm saying, though, that I will, if a nutritionist wants to get up and we can combine, economic outlook with what that means for nutrition on farm, that's going to be a much better answer to your question than some guy like me just going up and giving that answer. So I'll admit I'm over my head. I don't know. Yeah.
From the standpoint of the environmental economic question, able to distill all of your information and perspectives into a simple question, is 2022 a good time to build a pig farm?
I know a lot of really smart people in the industry, and they're answering by not building right now. They're not in expansion mode. They're not in contraction mode, but they're not in expansion mode. Does that help answer that?
Yeah. I've read that the Chinese economy
I'm more worried about communism than I am. Yes.
Likely, right? Probably yes.
But that's the dependence on one customer. Like if you're we should have learned through all of this chip shortage, pandemic, all this other stuff that being trade war, dependence on one customer is an absolutely disastrous business model.
It's just such a murky country to find reliable data to come from too. So even reported numbers are sometimes taken with a grain of salt. So it's a gray area, and there's no good answer to know really what's happening over there.
Yeah.
100 years ago, we went through a similar pandemic, and afterwards, there was quite a bit of pent-up demand. We went through the roaring 20s and the rising back. Can you compare today to that 100 years ago relative to the factors that were increasing, or where we're headed over the next 1 to 7 years?
So the question is about the last pandemic led into a big spending spree in the 20s and then the crash into the 30s.
Oh man, good question.
I'll say no because they didn't have high-speed internet back then.
That's it.
And so they didn't get to read all the news that they wanted to read about how either terrible things are or how good things are. So they didn't have CNN and Fox News back then. So I don't think the two times are comparable because I think what we will see with high-speed internet is high-speed economic increases and decrease. And I mean, it's just the volatility of those is going to go. It's going to go faster and further, but it's going to go quicker. So we might have already experienced the roaring 20s in the last 18 months. Does that help? My thoughts, anyway.
China, for stealing of our intellectual property and preservation, it's come at a huge price in agriculture, let alone the intelligence world. We are agricultural publication, I read seed genetics or swine genetics and other animal health things. What have we learned from that, and how that impacted the financial markets going forward?
Another good question. Do you want to touch on the ag, not touch on the financial markets?
Yeah, give me a second.
Okay.
So you go on the financial side.
I think IP going overseas to China is absolutely a problem. How it impacts markets, it's largely been ignored. Stock market keeps going up. Companies still make money. Margins are improving. As far as rates go, I don't have a great answer for you, to be honest. I wish I did. They're their own, communist government. They're going to do whatever they want to do. If they want to keep stealing, it's almost up to the corporations to build up those brick walls around their IP to protect themselves from it. And if they can, still capture some margin, despite some of that being copied overseas, I think that's a problem that they've been tackling for decades. It's definitely not within the last few years. I guess that's the best way I can think about that problem.
So the only way to address that question is through politics. So in order for people to understand my politics, I want you to understand I hate them all, but nobody good wants the job. I mean, who good is gonna put their family through that to run for office in this environment, except somebody with just a ridiculously huge ego? But they called phase one of the trade war deal with China phase one because there was supposed to be phase 2, 3, 4, and beyond. The first part of the trade war was fought on the backs of everybody in this room. And we felt that. We felt that big time. We're still feeling the impacts of it now. Phase 2 and Phase 3 and 4 was going to be fought on the backs of the FANG companies, Facebook, Amazon, Apple, Netflix, Google, the technology companies, because the Chinese stealing of U.S. and production agriculture stuff has been rampant for years. That was going to be put a stop to it, right? Then they were going to, but they were going to fight it with their money next. They have a lot more money than the ag people do, and they also saw that as a major threat to their earnings. They didn't want to fight that part of the trade war because there was an opportunity to really put a halt to it, and that's war, right? I mean and they didn't want to. The big money in this country didn't want to fight that, and that's why we've seen some of the things politically that we've seen here in the last couple of years. So my opinion is that could have been very negative for those technology companies if we were going to go to do a trade war with China, but then we were going to have Google's IP up as our firepower for the trade war.